Welcome to The Explainer. We're jumping right into it today, looking at an absolute Wall Street titan. I mean, for over 150 years, Goldman Sachs has literally been the pinnacle of financial power. But right now, in August of 2026, this legendary firm is sitting at a really fascinating crossroads. The stock has just exploded, literally doubling in the past year. It's being fueled by this massive AI boom and some totally record-breaking trading revenues. But at the exact same time, there are some flashing warning signs we absolutely cannot ignore. So here's the core dilemma every single investor is staring down right now. When you see a stock double in just 1 year, you're forced to ask a really tough question. Is Goldman Sachs a screaming buy that you need to get into right this second? Or are we looking at a classic case where all the good news is already perfectly priced in? To figure that out, we've got to look past the hype and dive straight into the data. Section 1. The thesis. Explosive financials. Let's start right off with the bull case here. To understand why Goldman is surging, you just have to look at their raw second quarter 2026 numbers. They are stunning. We're talking $20.3 billion in net revenues. And that's not just a minor beat, that's a massive 39% jump compared to the exact same time last year. Think about that for a second. For a company of this size, this level of maturity, to grow its top line by nearly 40% in a single year, that is practically unheard of. And what's really wild is how that revenue translated directly to the bottom line, an incredible $21 in earnings per share. That completely blew past Wall Street's expectations. It basically shows us that Goldman isn't just raking in more cash, they are ruthlessly efficient at turning that revenue into pure profit for their shareholders. So, where's all this explosive growth actually coming from? Well, right from the trading floor. We are seeing a massive 72% year-over-year surge in equity trading revenue alone. And right next to that, FICC, fixed income, currencies, and commodities. That's up 32%. Put simply, when the financial markets are moving at warp speed, Goldman Sachs prints money. You can really look at these numbers as the result of a perfect storm of global volatility. Just think about what's happening out there right now. We've got high geopolitical tensions, huge uncertainties around global tariffs, and major policy shifts happening under Federal Reserve Chairman Kevin Warsh. Now, that kind of chaos might make everyday investors a little nervous, but it is the ultimate playground for Goldman. They act as the ultimate market middleman, and they are getting paid handsomely to navigate all this turbulence for their clients. Section 2, the trillion-dollar AI bet. Let's shift gears to the elephant in the room. Why is this more than just a temporary trading boost? Because at its core, this is rapidly turning into a massive artificial intelligence story. Now, you might be thinking, wait, how does a 150-year-old bank become an AI stock? Well, check out this recent note from Bank of America. They literally call Goldman Sachs the most direct way to play the AI boom in the financial sector. See, Goldman isn't building the microchips or writing the code, but they hold the keys to the kingdom, the actual capital required to make all this AI stuff a reality. The sheer scale of what's happening here is crucial. The semiconductor industry alone is projected to hit a mind-blowing $2.7 trillion market cap by 2030. But to actually get there, tech companies have to build unprecedented levels of infrastructure. We're talking massive data centers, huge power grids, highly specialized facilities. All of that costs hundreds of billions of dollars. And someone has to finance, structure, and underwrite that capital. That someone? It's Goldman Sachs. And we're watching this play out in real time. Goldman is aggressively pivoting from just being a pure trading firm to an absolute asset management powerhouse. They are right now in talks to underwrite Nvidia's massive $500 billion AI infrastructure initiative. They aren't just sitting on the sidelines giving advice, they're actively underwriting the deals. This puts them right at the absolute epicenter of the biggest capital expenditure cycle of our generation. Moving to Section 3, building stable revenue. So what is management doing with all these massive windfalls from the trading boom and AI financing? They're actually using their own highly valued stock to buy stable, long-term revenue. Trading is great, but let's face it, it's super volatile. So on August 18th, Goldman announced they're acquiring LCN Capital Partners, a commercial real estate manager, in a deal worth up to $410 million. And notice this, 80% of that was paid in Goldman stock. They know their stock is expensive right now, and they're smartly using it as currency. Plus, they launched a $1 billion Bermuda reinsurance sidecar, which is basically a co-investment vehicle to share risk and lock in steady returns. It's a brilliant move, honestly. They are taking this wild, volatile trading money and trying to build a predictable earnings machine by stacking up fee-based income from real estate and insurance. Section 4. The antithesis, Wall Street's analysts divide. Now let's pivot to the bear case.
Because despite the record numbers, the AI tailwinds, and the smart buyouts, Wall Street analysts are surprisingly hesitant. You'd think a stock posting 40% revenue growth would have everyone screaming from the rooftops to buy. But out of 25 analysts tracking the stock, an overwhelming 16 of them are sitting firmly on a hold rating. There are only 6 buys and 3 sells. The average one-year price target is around $1,142, which implies just an 8.5% upside from its current price. That tells us a lot of these professionals think the good news is already fully baked in.
And there is a massive chasm in expectations going on. On one side, you've got ultra-bullish tech optimists like Bank of America slapping a $1,300 price target on it, banking entirely on that AI infrastructure pipeline. But then, on the exact same asset, cautious bears at UBS and RBC Capital are holding steady at $730. That is a massive 30% drop from where it's trading right now. Honestly, it is incredibly rare to see top-tier analysts disagree this dramatically. So why are those bears so spooked?
Well, it comes down to core valuation risk. Guru Focus estimates Goldman's actual intrinsic fair value is sitting right around $816. That means the stock is currently trading at a steep 29% premium above its true intrinsic value. Investors are paying top dollar for all this expected future growth. And if that AI growth slows down even a little bit, this stock has a really long way to fall just to get back to fair value.
Section 5. Warning signs from the inside. Because honestly, the absolute biggest red flags aren't coming from outside analysts crunching numbers. They're coming from inside the house. Take a look at this striking warning directly from Goldman's own CEO, David Solomon. He recently stated that the current market is being driven by more greed than fear and actively warned about the risks of persistent inflation. I mean, take a second and really process that. When the CEO of the company you're investing in is openly telling you the market is getting greedy, you probably want to listen. Those are not the words of a leader who thinks the easy money is still out there. And then back that up with data from Goldman's own trading desks. Their internal numbers show that client exposure to AI and semiconductor stocks has basically skyrocketed, jumping from 10% to 24% of net long positions. That means direct bets that the stocks will just keep going up. On Wall Street, they call this a dangerously crowded trade. Literally everyone is rushing to the exact same side of the boat. So if persistent inflation forces the Fed to actually hike rates again, which is historically awful for banks, it really wouldn't take much to trigger a massive panicky sell-off. Finally, Section 6, the synthesis, the verdict. Let's pull all these threads together. So here is the balanced view. On the bullish side of the ledger, the momentum is totally undeniable. Goldman is perfectly positioned to finance the entire AI infrastructure boom. They're raking in record trading revenues in a chaotic world, they're smartly diversifying into boring but stable assets, and they crushed the Fed stress tests so easily they were able to hike their dividend to $5 a share. But on the bearish side, you are buying a stock at all-time highs with a highly stretched valuation. Your margin of safety is razor thin, the whole AI trade is dangerously crowded, and even their own CEO is waving a yellow flag about greed and inflation risks. Which really brings us to the ultimate question, the one you have to answer for yourself. Will the underlying reality of this AI infrastructure cycle actually outlast the current wave of market hype? Look, if you believe this is a multi-decade, world-changing build-out, then Goldman is your financier. But if you think the hype has totally outrun the reality, well, that 29% premium might just be a trap. I really hope this explainer gave you a clear, structured framework for your own research. Thank you so much for joining us today, and I absolutely can't wait to explore our next topic with you.